Hello, everybody. Welcome to the space on long-term investing. I'm super excited for this. I see we already have Ryan up here. I'm going to give a little bit of time to get some of our, a couple of our other speakers in here. I did send out all the invites. You need to get the tweet out and everything. So we need a minute or two in here before we do get into the full swings of it. But yeah, so I'm super excited to get going with this. I see we now have my amazing and wonderful co-host up here, Wolf Financial. How we feeling, Wolf?
Doing good, man. I just had a pretty cool chat. It's nice, like meeting some people that you kind of seen on Twitter for a long time on a Zoom call behind the scenes and like picking their brain. What it was with a
Yes.
certain Mr. Rich.
Oh, with a certain Mr. Rich, is it the one that I'm thinking of, or
The scene,
the offspring of the one I'm
the
thinking
senior,
of?
the senior.
Oh, okay, that's very cool. I was surprised when he was on the Spaces the other day and actually talked a
Yeah,
little. It was
we've been
very nice
chatting
to see.
more.
Awesome. Well, actually, it looks like we're getting a couple more of our speakers flowing in here. First, I want to throw it over to Ryan. I know you were in here first. I love being the punctualness. Love to have that. I mean, not that anyone else was late. We are literally haven't even gotten started. But yeah, I want to reward you for being first. Throw it over to you first here. First of all, it's nice to meet you. I think the first time we've gotten to talk on these spaces, but a little bit about how you are and how your week has been so far.
Yeah, thanks for having me. I'm actually really excited to do this. I am punctual, so you're going to get that from me. You can take that to the bank, my friend. I'm doing really good. It's been a good week despite all of the volatility and what's going on. We've been able to stay safe. Just been kind of doing a lot of shorter term trades just to kind of keep myself green. But the long term stuff that I have, we're going to talk about here today, it's been holding up, been doing well, so no complaints.
I see we also got Simon up here. How you doing, Simon? Always love having you on the spaces.
Hey, Evan, thanks for having me. I'm a bit under the weather here today, but I always enjoy being here with you. Really excited to chat about long-term investing with you.
Those
Bear
damn
with me.
kids getting you sick.
It is those cesspools of Montessori school, and they bring it back. The kids somehow remain unharmed from that, but us as parents, we're the ones that get it in the long term. I apologize in advance for my slightly hoarse throat and voice today.
No worries, Simon. The stuff that you'll be saying will make up for it. It's gonna be so knowledgeable. It always is. So always love having you. We'll try and keep the burden off your voice decent today, so we don't gotta rely on you too much. But that's just to save you from you. We always love having more Simon. Before I do throw it over to Brad for our final intro, I did just want to say I did pin the tweet that we are live, the live tweet above in the nest. If anyone in the crowd wants to go and support us, get more people in here, we just appreciate if you guys could share that out. Any of my speakers, if they want to tweet it out from their own timeline. And I know a couple people can sometimes be skittish about retweets and whatever like that. If you hit the like button on that tweet, it's pinned up above in the nest. It will get sent out to all my followers, all the stock market news followers, everything like that. The algo loves when you hit that like button. So just yeah, would definitely appreciate that. And with that, I'll throw it over to you, Brad, here a little bit about how your week has been so far and how you've been.
Yeah, pretty wild week. Did a little bit of adding on Monday, and then my largest position by a pretty wide margin is CrowdStrike, and they reported last night, and fortunately George Kurtz gave me a lot to be happy about, as he often does. So I'm planning on talking through that report with everybody, and excited to hear from the rest of our talented speakers.
Yes, I'm super excited of it. Speaking of the conversation earlier, Wolf, we got John B. Rich down below. Shout out to his account, John W. Rich. Why do I say John B. Rich? That feels right. I don't know. Maybe it was that in the past. But John W. Rich, one of the top meme accounts on here. And actually, I've heard him speak on Space a couple times. Very smart and knowledgeable guy as well. Wolf, is he unmuted?
It can't be John Beerich. The W stands for wealthy.
That's true. All right, you're fair. I don't know. Maybe I'm just speaking out of the behind there with the John B. Rich, but love that. Big shout out to him. I want to give a quick preface on what the reasoning for this long term investing space is, and then I'll get us right into it. So there are so many spaces on FinTwit, and we love to see it. But I'm noticing that a lot of them are really focused on short term trading, live trading, options, everything like that. And that's fantastic. That's great for that crew of people. But the average investor out there is a long-term investor. Where's those spaces for us? Well, I'm trying to bring that to everyone. We've been doing the spaces every single week for the last couple of months. Brad has been a regular on here. Simon's been on a bunch of these. I'm really excited to have Ryan and the Benzinga crew on here for this time. And yeah, so super excited for this space going forward. the whole purpose of this is to be educational. We are going to, talk through deep dives on stocks, and it's not necessarily, hey, go buy this stock. It's, this is what someone who does deep dives on stuff, this is the type of numbers they look for, the type of terms they're researching into, that whole type of thing. If you can really take what someone's saying and take the second order of it, not what they're saying, but the process at which they're getting to that opinion, I think that is where you will be taking the most out of the spaces. So to my speakers in general, anywhere we can be extra educational, to anyone along the spectrum, new to experienced investor trader, that is what the purpose of the space is. So I'm super excited for that, and I get us going into it. Simon, I would love to throw it over to you first and hear a little bit on the topic of Affirm.
Well, thanks very much, Evan. Thanks very much for having me. I always love hearing from the other speakers as well. One that has really got my attention lately is Affirm. This is one of the leaders that's becoming known in the buy now, pay later space. It is also a stock that over the past 3 months is down 70%, hated by the market. It is absolutely hated by the market right now. But as a long-term investor, there are a lot of things that I like. I think that this is a company that the punchline might be, it's going to be a short-term hated stock, but a long-term opportunity. Just to review it really quickly for anyone who's unfamiliar with the company, buy now, pay later allows people to purchase things and pay their installments over time. It is a direct competitor to credit cards. In the US alone, we're paying $120 billion a year in credit card fees and another $15 billion for unexpected fees. There's got to be more transparency in finance. And so CEO and co-founder of Affirm, Max Levchin, basically takes this upon himself to say, let's make an honest financial products to improve the lives of people. And that's what he's packaged and now is becoming known as buy now, pay later. Affirm makes money from two sides, right? It's from the consumers and also the merchants. If you download the Affirm app and use it for purchases, you can get an interest rate for your purchases of 0 to 30%, depending on the time frame. Could be from 6 weeks to 5 years. Again, you're not compounding interest like you would for a credit card. It just built into longer installment payments. And then also from the merchants, they're paying 2 to 6% basically of a take rate of the gross merchandise volume that's paid. But it's really interesting because for both sides of this, there's a benefit. If you are tired of getting raked over the coals and you don't like credit cards and all those fees that you traditionally paid, you might want to see upfront a more transparent way of how to pay for things. And then also for the merchant side, if you can use the Affirm app to increase your lift and your conversion of everything that you're selling, let Affirm do the marketing work for you. They kind of consider this to be the marketing gold mine for any retailers out there that want to use them. And that's why you've seen so many partnerships that Affirm has been signing in recent years. And we're going to get to that in just a minute as I talk about the long-term perspective on this. But first, let's talk about the short term. Let's first talk about why this stock is down 70% in 3 months. First of all, Peloton, we can't ignore the elephant in the room, which is Peloton is having some serious financial problems right now. Peloton was the firm's second largest merchant by GMV, by gross merchandise volume. Almost all of the installment plans were 0% consumer loans. They would only charge Peloton a take rate for initiating them, and it would be free financing with the consumer side of it. But the take rate from Peloton was up to 12.5% sometimes. That's much, much higher than the 4 to 6% that it was typically charging to merchants. And of course, a more expensive purchase like Peloton, which is paid off over a period of 5 years rather than 6 weeks, was very, very interesting for them. But again, you've got kind of some short-term headwinds as we've seen the Peloton story unfolding, and that's certainly affected Affirm's business. And then the second elephant in the room right now, I think, is interest rates and whether or not consumers are going to be able to repay. Are they going to have a whole bunch of delinquent loans that Affirm is sitting on its balance sheet? Because a lot of the loans, it's actually holding on to itself. It's not securitizing them. It's not selling them off to others. It's not having some other debt collector that comes out and knocks on your door saying you owe us money. They want to preserve that trust with consumers. And so they hold a lot of these on their own balance sheet. They raise the capital from other financiers, mostly US-based banks. And I think that this is a concern that investors, where you were talking earlier, Evan, about a metric that investors should be looking at. I think the allowance for losses is one that we should pay attention to as long-term investors for Affirm. Specifically, the allowance for loans that are held for investment, right? So these are the loans that Affirm makes. Obviously, they got to pay the merchant, but then they've got to collect from the consumers over time. This is something that you kind of always set aside an allowance for what percentage of those you're going to write off. For a traditional large bank that might be pretty conservative, maybe a 1 or 2% allowance might be acceptable. Affirm has a 6.8% allowance for loans to be written off from the investments that it's holding on its balance sheet. That's very high, possibly 3 to 4 times higher than most conservative banks. And so that's why you don't see everybody jumping into this buy now, pay later space. It's something that's new. It's a model that hasn't truly been proven. There's a lot of risks. Of course, a lot of people are thinking about 2008. There's a zillion reasons with inflation rates interest rates and inflation spiking higher right now to avoid this stock. And that's why you've seen this short-term sell-off in the market. But as a long-term investor, Evan, I know you always have me on this show because Seven Investing is long-term investors. We're able to see past 3 months, 6 months, or a year and say, are there things in place that we really like about these companies that might be out of favor right now? Affirm is getting a very early lead in becoming the top dog in this space. I have personally spoken with Max Levchin at conferences before buy now, pay later was even a thing, before it was even being called that. It was just transparency and finance. And he is getting a lot of partnerships that he's signing with some large retailers out there, including Walmart, including Amazon, including Expedia for travel, and of course, including Shopify. Shopify is working with Affirm through something called split pay, where they would have all of the upfront payment come from the merchants, maybe around a 5% take rate for that. Again, a 0% APR over a shorter term loan. That has been incredibly successful. Of course, Shopify, a huge company. The same thing with Amazon. Amazon is offering a pay over time solution for Affirm for purchases that are over $50 for select customers. Now, of course, there's installment options for Amazon or for Walmart or for Shopify to offer this themselves. They've got deep enough pockets, but there's really some magic working behind the scenes in Affirm's algorithms, not only one to identify and weed out using the proprietary scoring mechanism, the people who won't be able to pay over time, right? You don't want to make bad loans to people who aren't going to repay them. One, it's a financial risk. Two, it's a brand reputation risk. You have to collect on those. But secondly, the lift for retailers. It's underappreciated right now that if Affirm can become an app that keeps getting more and more users, it keeps getting more and more transactions per user. Now got 11 million consumers using its app, rising 150% year over year. As you see that gross merchandise volume spiking, and retailers are going to start going to where the eyeballs are and where the attention is. And I think that that's something that Affirm has got a real step up on any of its competitors that are out there trying to do this. And that includes Square. Square went out and spent $29 billion on Afterpay. And we've seen PayPal, exploring this option as well. And of course, a lot of smaller buy now, pay later companies. But I think that Levchin, being CTO of PayPal, back in the day, PayPal Mafia, a guy that just loves algorithms, loves, getting into the nitty gritty and using technology to his advantage. It's something I really like as an investor. And so, Evan, I think that this is one of those battlegrounds. There's a lot of strong opinions about Affirm, a lot of strong opinions about consumer credit in general. This is one that's going to incite some fire from a lot of people. I'd love to chat with people that have alternative views to it. But for me as a long-term investor, especially looking at kind of a loan portfolio, looking at how they're doing the algorithms, they're running their business conservatively. I think they're going to be okay as interest rates go up. And I think you've got the right person at the helm that's going to lead this business into a long-term successful future.
I want to ask you a little bit more about the competition in the space. It feels like there's multiple companies kind of going after the same prize here. Is it, or do you kind of see this as a winner takes all industry that's going to shape out into, or you think there's going to be multiple winners? It's a pretty broad prize up for grabs.
Well, Evan, if you go to 7investing.com and you come to our checkout page, you're going to have a couple options today, right? You can't pay in cash and Bitcoin yet. We're working on that. But you can pay typically with a debit card or a credit card. And PayPal is kind of, one of the other options that almost all vendors will have. But there's limited space that vendors want to offer as a payment option. And so you could have, pay with PayPal, pay with Square, pay with Bitcoin, pay with Afterpay, pay with 17 other buy now, pay later solutions, or you could just say, hey, I want to offer the one where the most people are going to use it. And I think that's the benefit that you're going to see from Affirm over its competitors is it rises up and it becomes the leader in this space that a lot of the others are hesitant to use. And you start seeing transactions per user up 15% year over year, total transactions up 218% year over year, GMV up 115% fiscal year over year. I mean, there's clear signs that if you're going to work with just one buy now, pay later vendor, and you have limited space for options for your own customers to pay for things in your checkout page, you probably want to work with the winner take most. You could use the lesser used ones and place them instead, and they'll probably offer more favorable terms as they're trying to gain their own market share. But at the end of the day, you kind of want to go with the winner in a payment space like this.
Oops, sorry, I had to get back. So I want to ask you just one more question. We'll let your voice rest and maybe come back to you for the C limited part that I know we had some discussions about. But how do you kind of go about evaluating a firm versus competitors in that space? Like, is there something about firm strategy, management, or something in there that gives you that extra confidence over someone like a Afterpay and Square or the other players in this space? Yeah.
I think it's all about trust, right? It's all about trust in this. Consumer finance has been burned. I think banks and credit cards are probably like the most hated companies on the planet for some people, right? They hit you with fees, they charge you interest rates you didn't really agree to because they increase over time. You didn't know what you were getting into when you took the loan, and then all of a sudden people get buried. And unfortunately, there's some terrible stories that come from this. And so really the transparency angle, the how do you evaluate them and what's the goal? I mean, NPS score, net promoter score is one that's underappreciated in this space. Are people trusting of a firm as a solution who's not going to manipulate them and take advantage of them? Affirm's NPS score last I checked last year was 78. I haven't checked on this year because I haven't seen the results for it recently, but that's very, very high, right? That's higher than companies like Apple and Target, the most loved consumer brands that are out there. And so for a financial company to be in that kind of level that's loved by consumers, they should be posting that on every single billboard they have out there saying, hey, do you want someone you can trust who's going to give you another payment option because you don't like your existing options that you have right now? So I think it's NPS and trust, to answer the question of what makes them really stand out in the long term.
Awesome, Simon. I appreciate that. Anyone in the crowd, make sure you're checking out Simon and Seven Investing, his company that he runs and is the CEO of, lead advisor as well. Doing some fantastic stuff there. I believe the link would be in your profile, right?
Yeah, and in fact, Evan, it's our birthday this month. This is kind of an exciting time. We just turned 2 years old, right? Seven Investing started in March of 2020, and so we're kind of offering an unprecedented and ridiculous offer right now. I don't know if we'll ever do this again, but only for our birthday would we do something ridiculous like this. We're going to offer the first month for $7, just because we think that there's more value in getting into the nitty gritty of our reports with us and looking at, why is Seven Investing recommending these companies? What are the metrics that Simon's looking at for his reports or the 6 other advisors on this team? So anybody who goes to seveninvesting.com/subscribe and then uses the promo code 7, the number 7, is going to get that first month for $7. We certainly hope you stick around, but at least take us up on this ridiculous offer to come in and take a look at all of our recommendations and see if there's anything you really like.
Awesome. Definitely go in and check that out. And once again, the link to find that is in Simon's profile. So definitely go and check that out. And then Seven Investing, I think, is one of the first companies that I really found on FinTwit, and then I've been with and watching for the last probably my perspective year and a half. So definitely very legit guys, and I love having Simon on this space, giving his thoughts. A very smart long-term investor. But definitely enough of that. Definitely check him out. Give him a follow. I'll keep us moving on. Big shout out to you, Simon. But I want to throw it over to Brad now, stock market nerd, who's also a very, very smart guy. We'll get into a little bit of the stuff that he's doing outside of it, but he's going to talk us through a little bit of CrowdStrike's earnings.
Yeah, so one of Twitter's favorite companies, one of my favorite companies, and I think this is really one of those pandemic darlings that has proven itself as a sustainable and wildly profitable compounder over the years to come, as long as the status quo remains. And I'm kind of going to talk through how this quarter served as just yet another data point supporting that opinion. So the company guided to about $410 million in revenue. It posted $431. That beat its own expectations by 5.2%. That was the largest beat the company's had in 4 quarters. For the year as a whole, It's dollar-based net retention rate, which is how much revenue is its year-over-year existing cohort of customers contributing. Very important metric for continued growth and for upselling. So dollar-based net retention was 124% for 2021 versus 125% year over year, and then 124% 2 years ago. So pretty stable. Gross retentions remaining at a best-in-class 98.1%, which actually ticked up a little bit. Some things I wanted to point out from the demand side of things is that RPO, which is remaining performance obligations, which is it's really a great indicator of forward-looking demand and how revenue is going to look in the future. So that growth actually outpaced from a sequential and year-over-year perspective ARR, so annual recurring revenue, subscription revenue, revenue growth overall. So the forward-looking metrics are accelerating, which is pretty exciting to think about considering this company is growing revenue 63% year over year already. Module adoption, which is very important for CrowdStrike. They have 22 total modules now versus 19 year over year. Why this is so important is that CrowdStrike's fixed costs are really all incurred when they sell that first module to a client. So once they sell module 2 and 3 and 4, it's really pure margin revenue, and it really bolsters the operating income, net income line, and everything else you want to think about on the financial statements. So that is very much so direct evidence of continued margin expansion to come, considering the fact that customers with 5+ modules is at 57% versus 47% year over year and 33% right as we were entering the pandemic. So really good uptake in modules. From a profitability perspective, which I know in this macroeconomic hawkish backdrop that we're now all finding ourselves in, that's much more important. And fortunately, CrowdStrike excels there as well. So it guided to $57 million in non-GAAP operating income. It posted $80 million. It guided to $47 million in net income. It posted $70 million. Analysts and CrowdStrike were both looking for about 20 cents per share in earnings. It beat that by 50%, posting 30 cents per share. A note on the free cash flow margin, which took a hit year over year. That was from an intellectual property, so IP tax transfer related to its purchase of Humio, which is a log management service that it's doing a lot of great work about that I'll talk about in a second. But without this headwind, free cash flow margin would have been 45.7%. Now, that does have a lot to do with deferred revenue and stock-based compensation. So they're not, and somebody commented on this yesterday, and I think it was a good comment to make and good context to add. CrowdStrike is not going to do 46% free cash flow margins in perpetuity for the future going forward. There will be one-off quarters like this where it does post around a ridiculous cash flow margin like this, and then there will be other quarters like Q2 2022, which is their calendar 2021, where they posted 21% free cash flow margin. So their long-term target is 30%. They've now eclipsed that for 2 years in a row. They were at 35% this year. So that is really the metric or the level of free cash flow margin that we should be looking for going forward. But also, I mean, looking at operating margin, expanded 5.7% year over year to 18.7%. Net income margin expanded 4.5% year over year to 16.3%. The guide that they put out implies growth in operating income and net income that will again greatly surpass the 48% growth that it guided to for next year, which points to even more multiple expansion to come. And then speaking of the 2022 guide, which for them it's fiscal 2023, but it's calendar 2022, just a little weird. But with that being said, they raised their guide by 7%. From a demand perspective, they raised their net income guide by 15% for 2022. This was all organic. Secure Circle is still not really contributing any material revenue or profit for them. So this was all an organic raise. And then moving on to some management commentary, the criticism for CrowdStrike in the past has been that this is really an endpoint company and that's the only niche that it's going to find success in. And that does not really seem to be the case. And I'll tell you why. So not endpoint modules. This includes Humio and log management. This includes cloud security, identity, and zero trust. So from the Preempt acquisition. So annual recurring revenue from their non-core endpoint segments is more than doubling year over year to 157 million in annual recurring revenue. In Q4, this past quarter, that was actually 17% of CrowdStrike's new business. That is rapidly rising, more than doubling year over year. So the idea that this is going to be an endpoint security company in 5 years, I don't think is a right one. And that's just a strong data point supporting my opinion, which could always be wrong, but that's why I think so. So some customer wins that were highlighted. Cloudflare is now a CrowdStrike customer. So when you have companies like Cloudflare and Zscaler and Okta and other next generation disruptors operating in other segments of the cybersecurity space, and you have them nodding to CrowdStrike and saying, yeah, we want you, we want your services, and you're going to be our choice for endpoint, that's just another encouraging sign to me, in my biased opinion. So a record number of cloud workload contracts. They won a Fortune 50 energy company, a Fortune 250 software company. I could go on and on and on about how many Fortune 500 brands they won during the quarter. They added 77 Fortune 500 members as customers during calendar 2021. So what is that? Let me try to do some quick math. That's 15% of the Fortune 500 roughly that they added as customers alone in 2021. Another hit on CrowdStrike is that they're not a good partner. They don't play nice with partners, and their partner source annual recurring revenue grew 83% year over year, with managed service provider revenue more than tripling. So that narrative also kind of took a hit. In terms of talking on the competitive landscape, just as always, Kurtz came out firing. He didn't use SentinelOne's name in particular like he did several times last quarter. I was happy about that. There's no reason to rip into other competition. It does make for good quotes for me in Twitter, and I enjoy the content that he gives. But just commenting on Fortune 500 companies having next gen contracts in place that failed to scale in 6 months, and then them filling the void in weeks. Just anecdotes like that. That's all I need. I don't need him to say SentinelOne specifically, but I'm pretty sure he was talking about SentinelOne. But moving on, for some important CFO comments. So CrowdStrike has what's called an incident response team, which is basically a lead generation source for them. So a demand channel that they use to juice their top line. So what it is they're not usually existing customers, but prospective customers that have had existing security solutions that have failed them. They're dealing with a breach or some hack, and CrowdStrike comes in and cleans up their mess. In calendar Q4 2021, $1 in CrowdStrike spending on this incident response business yielded $5.71 in new ARR. That rose a little bit year over year, but it was at $3 a little over a year ago. So that we're just showing explosive growth in terms of both their demand and the efficiency of attaining this demand, and that's only getting better and better, especially considering their magic number, which that's net new subscription revenue divided by 4 or times 4 divided by sales and marketing expense. So that's really a barometer of how efficient their marketing spend is. That's at 1.3, which essentially means $1 in marketing immediately yields $1, for the year yields $1.30 in revenue. And for in high margin revenue, by the way, and for the company, any metric above 1.0, and this is a quote from CFO Bert Podbear, is a sign to lean more heavily into growth. So again, 62% top line growth, 67% remaining performance obligation growth, and they still see ample opportunity to continue leaning in more heavily. In terms of next year, or I guess this year commentary, the quote we got was, "We entered the quarter with our strongest Q1 pipeline ever. We remain optimistic about demand for our offering, and we see none of the momentum fading." One thing to point out, ARR growth sequentially next quarter, will be impacted by 2 massive 8-figure deals that CrowdStrike landed in the last quarter. Interestingly, this was not CISA, which is the cybersecurity federal body that gave CrowdStrike a massive contract last quarter. That was not one of the 8-figure deals. And based on management commentary, it did not sound like that ARR ramp had even begun yet, which means what will eventually be one of their largest customers is pretty much entirely ahead of the company. So again, exciting to think about. With all of that being said, so the elephant in the room, and I'm just pulling up CoiFin multiples pretty quickly. With CrowdStrike's EV right now, sitting at around 40 billion or something like that. And let me just pull up these multiples super quick. I should have been more prepared. That's on me. But they're trading at about 19 times sales. So that is elevated any way you slice it. But at the same time, 19 times sales with a 35% free cash flow margin. Doing some more quick math. That's 55 times. That's 55 times cash flow, with cash flow growing faster than 55% year over year. And their earnings multiple is similarly elevated at about 130 times. But net income is also more than doubling year over year. So the PEG ratio, which is price to earnings divided by earnings growth, that a lot of growth investors use to justify hefty multiples, because I mean the faster net income is growing, the more palatable higher net income multiples are. But for CrowdStrike, the significant growth we're seeing has these PEG ratios, both from a net income perspective and from a free cash flow perspective, right around 1, which is pretty compelling in the grand scheme of things when you look around at all of its other competitors, its direct and indirect competitors within SaaS. That is not that is not ridiculous. Now, it's not to say that the company is cheap. I will never call 18 times sales cheap, but I don't think this company is going to be cheap for a very, very long time. They're a market share leader in an industry providing significant secular tailwinds. That will be a tide that lifts all boats, but I think its boat is going to be lifted even higher just based on the incremental value proposition it can offer compared to everyone else. So I have to leave you guys all with saying that I'm obviously biased. This is my largest position. So clearly, I skew towards saying nice things about the company when there are nice things to say about the company. So if you just got really excited for me talking about it for 10, 15 minutes, just go into some press releases or the S1 or some SEC filings or explore and see if what I just said actually makes sense to you and if it resonates and if you agree. Because if you don't, then there's many other amazing companies to invest in. I mean, you won't hurt my feelings at all by disagreeing with me. So that's all I have for CrowdStrike. Happy to talk about it more, and I will pass it back over to you, Ev.
Awesome, Brad. That was fantastic as always. I want to stay on the CrowdStrike topic and dig in a little bit more, one or two questions with it. So it's your largest holding. To me, that means you have to not only be very bullish on the stock, but you also have to be very bullish on the sector in general. I would love to kind of like take a step back and maybe get your overall thoughts on cybersecurity sector. And also, side note along with that, I am a complete, I'm going to say noob for, we're going to bring in some of the video game terms here. I don't know too much about the cybersecurity sector. Could maybe explain a little bit like how does CrowdStrike compare to an Okta and some of these other players as well?
Great question. I'm going to answer the second one first, and I already forgot your first question. So if you could re-ask me after I answer the second one, that would be greatly appreciated. But in this world of cybersecurity, there are really three buckets that companies operate in. So CrowdStrike is in the endpoint protection or the cloud security, or I'm sorry, cloud workload, not cloud security, and sort of the container protection. So think about your iPhone or your work laptop or a cargo container, anything like that, any endpoint that needs securing. That is where CrowdStrike helps. And so moving on to the other niche where you kind of see Okta and Ping Identity and several other players. So, the Auth0, I think it's called, that Okta just purchased, was his largest competitor. That is really the identity niche. And when CrowdStrike talks about all these identity applications that it's releasing in terms of zero trust, that is very much so with an endpoint protection point of view in mind. CrowdStrike and Okta remain very close partners, remain customers of each other. So CrowdStrike is not trying to encroach on Okta's authorization technology, on their identity technology. Nothing. That it is merely trying to bolster endpoint with an identity lens. And then moving on, we have Cloudflare and Zscaler, or really Zscaler and then Cloudflare. I should say Zscaler first. That are really the next generation network security titans. So connecting, or I'm sorry, securing your connectivity, ensuring that your traffic is safe. So all three of these niches really complement each other quite wonderfully, which is why we see things like Zscaler and CrowdStrike pulling each other into massive deals pretty much every single quarter. And really what this does is it allows them to mirror the breadth and depth of what somebody like Palo Alto offers, which is endpoint protection and also network security all in one. So CrowdStrike and Zscaler kind of lumping themselves and their services and tying them in a neat little bow together allows them to kind of mimic the range of services that Palo Alto provides while doing so, in my biased view, in a better way. Now, Palo Alto is a great company. I don't want to rip on them, but there are a lot of studies indicating that CrowdStrike's endpoint protection is just a tad better at this point in time. So those are the three buckets. And then could you remind me of that first question one more time?
Yeah, 100%. Also, first of all, fantastic answer to that question as always. But so you know, uh, CrowdStrike is your largest holding. To me, that means you can't just be bullish about the stock. You have to be bullish about the sector. I'll give it to you though.
Yeah. So bullish about the sector. I think it is hard not to be bullish on the sector. And if you don't want to go stock picking in it, I think the thematic ETF play and finding a cybersecurity ETF is a perfectly fine way to go. But just thinking about this past year, we have countless Microsoft high-profile breaches. We had the Log4j breach. Now we have Russian hack activity accelerating even more with all this geopolitical tension going on. China and Iran and North Korea, the exact same pattern playing out. So the threat report that CrowdStrike released about a month ago, I think it was, just showed threat activity and breach activity rising by almost 100% year over year. So this really is a tide that lifts all boats. This and I know I'm sounding redundant there, but that is a perfect analogy because or not to call my own analogy perfect, but I think it's a fitting analogy. Just considering the fact that we have a cybersecurity industry that is set to grow in excess of global GDP by a wide margin for the in the years to come. And not only that, but we also have players like Symantec that are actively exiting the endpoint security area, and after Broadcom purchased them, and not even trying to compete with CrowdStrike within that segment anymore. So there's really a competitive environment that's kind of evolving into greenfield opportunity by virtue of competitors just kind of throwing their hands up. That will also juice CrowdStrike's growth in the years to come. In addition to the fact that cybersecurity and breaches are only accelerating, and that will continue in the future.
Yes, sir. Especially with this current environment going on, it feels like they've been more focused than they have been for the last year, 2 years, and it feels like that's only been increasing. Big shout out to you, Brad. Very knowledgeable. We throw like what? I feel like we've covered probably 10 to 12 stocks, like deep dives from you on this space, this series. So you can tell Brad is an extremely knowledgeable guy. I know he does have a free newsletter that goes out every single weekend. We can go a little bit more deeper into it when we go into wrap-ups, Brad, but we gonna have CrowdStrike in there?
Heck yeah, we're gonna have CrowdStrike in there, and then Upstart just released a new product and signed Volkswagen as a preferred partner. So a lot of good information or good news coming across the tape in light of this hectic price volatility, and it will all be shared as always in a condensed fashion on Saturday.
Awesome. So if you want some free reads, if you liked anything Brad said there and you want to get more information, you want to see on paper, click into his profile, check out his free newsletter, and you will not be disappointed. It goes out every single Saturday. So big shout out to Brad. I'll quit harping on that. Just in general, big shout out to all our speakers up here. Make sure you check them out. Give them a follow. They're posting some fantastic stuff, some fantastic content, very knowledgeable people up here. With that, I'm going to keep us moving and let Ryan, I almost said Brian, wow. Let Ryan get into it. Very excited to have you on here. First time. Very excited to hear what we have.
All right, awesome. And by the way, I get called Brian all the time, so don't even worry about that. I'll just let that one roll right off my back. I'm really excited to be here. Thanks again for having me. The stock that I want to talk about today is one that you probably haven't heard of. It's called Charah Solutions. That's ticker CHRA, Charlie Hotel Romeo Alpha. And basically what this company does is they do coal ash remediation. They turn the byproduct of that really toxic and poisonous coal ash into a green concrete. They also do environmental risk transfer. So they will they remediate the land and then they actually sell it back to the state. Basically, the power companies, the utilities, in order to close a coal-fired power plant, you actually need to remediate all of the coal ash. So what is coal ash? Anytime that you burn coal, the byproduct of that is coal ash. It is extremely toxic, both to human beings, animals, the environment. It's just really bad stuff. So in order to what these power plants do is they normally store these in ponds. Sometimes it's wetted so that it doesn't blow around if there's wind. Sometimes they cap these things. They're basically stored in the ground. And if you've ever been to one of these coal power plants, a lot of them actually sit on really nice pieces of property. They'll be on some type of waterway or something like that. And it would be, if it wasn't for the coal-fired power plant there, it would actually be a pretty desirable piece of land. So what Charah does is they actually remediate this land. They go in there, they clean up all of the coal ash. Again, they try to use the toxic waste they turn it into a green cement. It's actually the byproduct of that. They turn into a cement. And then they remediate the land and sell that back to the state or to a private developer if they're interested in something like that. What's so interesting about this is that there is a huge market for this. Okay, so we're looking at about $75 billion to $100 billion of a total addressable market to remediate these ash ponds. They estimate that there's 1,000+ ash ponds and landfill that require EPA mandated closure and remediation. So the other thing is that the EPA is kind of stepping this up, right? They're going to increase some of these mandates. It's also worth noting that the infrastructure bill has $12 billion earmarked for remediation services alone. Okay, remediation services alone. That's just one angle of their business. So the companies have to do this. They're being forced to do this, and now the government is going to help subsidize that. They currently have $3 billion in pending bids, and they look to grow very considerably over the next several years. Though the other thing that's really nice about this, especially in the current climate, is that this particular company is recession-proof because they do not rely on the consumer for their revenue. It's going to be the utility, and it doesn't matter if we're in a recession. People still need to use power. The power plant is still going to be generated. So they have earnings coming up here in March. We should get a lot of clarity on where they stand. We actually just had earnings from a competitor company. Ticker is IEA. That stands for Infrastructure and Energy. They reported great numbers. I expect the exact same out of Charah. And as mentioned, the EPA, the upcoming rules and the remediation of these big power plants, there's going to be hundreds of these going forward here. So as far as the remediation goes, this is a necessary component to closing some of the coal-fired power plants. And this administration has made a commitment to ESG. This company is an ESG theme and has a commitment to ESG itself. They have 35 years of experience doing this, and they have all of like the machines and the rail equipment ready to go. They have an excellent footprint in the United States, and there's a massive potential for international expansion. One of the things that's cool about this is that some of these international companies the international expansion that they could do is dealt with some of the companies that have already purchased some of the byproduct from them. So they already have existing relationships that they're looking to expand on. And Charah offers a suite of turnkey services to pretty much remediate this land. You know, the power company they sign the contract, they turn everything over to Charah. Charah does it, and at the end of the process, they actually own a piece of land that they sell back, whether it's to the state or to, like I had mentioned, a private developer. So there's multiple tangible avenues for growth with this particular company. The management team is excellent. They've been doing this for a long time. The CEO, Scott Sewell, he is an engineer. He's very, very knowledgeable. He actually came on Benzinga to talk about this, to talk about the exciting stuff that they're going to have coming up here. So really, really exciting. One of the other things that I wanted to mention is that we talked about the total addressable market. This also has a very, very high barrier to entry, right? So it's not as if someone else can just start a company like this and say, okay, well, we're going to remediate this ash pond at a cheaper price. It's a very, very high barrier to entry. And again, this stuff is extremely toxic. So if you don't do this right, it leads to a whole bunch of different health problems. Some of their biggest clients are the utilities that you've heard of. It's, Duke Energy, Dominion, Southern, all types of different huge power companies. And then perhaps one of the most exciting aspects about this, I talked a little bit about the byproduct sales. They actually have a new system that they are called EnviroSource. And this is basically, they ship this machine to the actual site, and the site converts the byproduct and the waste on site to a green concrete, which again is probably going to be used quite a bit as the infrastructure spending increases. And what's really exciting about this is that by sending the machine to the site, you now no longer have to transport this waste material, which of course produces a whole bunch of other potential problems. So lots of really exciting things. I can't wait to see what the earnings report is for this quarter. I think we're going to get a really good look at what we can expect going forward. One of the other things that they're doing, I don't know about the rest of the guys, but I like to poke around on Indeed and see how, are these companies hiring? Charah is hiring all over the place. They're hiring all different types of positions. The CEO, when he came on our show, already said that we have $3 billion worth of bids pending. There's another 10 billion potentially that they can get this year. Again, the total addressable market is about 100 billion. So we're talking about huge, long-standing contracts. And it's really exciting. It's good for the earth, and it's a company that knows what they're doing and has multiple avenues of growth. Can you guys still
Awesome,
hear me?
man. Yes, no,
Yeah.
sorry, I was getting back to the thing. I don't know why the dial on top, my spaces is always all the way to the right on the little dial on top. Try to swipe to the right to get back. But that was fantastic explanation for it. And I really want to start with a question of like, how do you find a stock like this? Like FinTwit loves these glitz and glam stocks, the game stocks, the AMCs, the stocks that we all see and know
Yep.
every single day. But there's no way. Maybe if you're an energy guy, you might know this stock, but there's no way you're going to really know this one. So what's kind of your process for finding these type of companies?
That's a great question. That can change based on what the company does. In this case, I like to follow a lot of the smart money, right? So I like to follow where real smart and successful people are positioning themselves. I believe that I'm early on Charah. I think that this company also has a potential to get acquired, frankly. For example, if Waste Management decided they wanted to get into the business of remediation, they can't just do it, right? They would need to buy a company that knows what to do. So one of the biggest holders of Charah is actually Portolan Capital Management. And Portolan is run by a guy named George McCabe, who used to be a former analyst for Peter Lynch. Now, Peter Lynch is arguably one of the greatest investors of all time. So if there's ever something that they really like or they're interested in, that will often pique my curiosity in this. And Portolan owns like 3.5 million shares of this company. There's not a lot of shares outstanding to begin with. So to sum it up, to make it as simple as possible, I like to follow the smart money. In the case of this company, there's clearly going to be an emphasis on green projects, whether it be like I mentioned, for the infrastructure on green concrete, but then also closing down these coal-fired power plants. We're talking about trying to switch over to renewable energy resources and things like that. So what the next question is, okay, so if we're going to move away from coal, what is required to do that? And it turns out that you can't just close a coal power plant and walk away from it. That's not going to work, right? You have to actually have this cleaned up. And Charah is one of the leaders here. I also think that as far as the environmental angle goes, I think this is only going to increase. They're not gonna just all of a sudden decide, oh yeah, we should go back and start opening more coal power plants. No, we want to move to a cleaner, more renewable source of energy. So I suspect that this is going to be a theme that is going to continue. Does that answer your question?
Yes, sir, it does. Definitely did. That definitely does. Appreciate that, as always. So I'm going to say this is ESG, although I'd say this is a little more specific in there. ESG gets used a little more broadly than it should, probably. But we're definitely in that ESG theme right now. Are there any kind of sectors or areas, like, the coal remediation is definitely not something that I would have thought of top of mind, and I'm sure there's so many of those little more niche areas in that. Are there any ones that kind of step up as top of mind for you that you kind of find interesting?
Yeah, great point. And just really quickly on the point of remediation, I'm new to it too, right? I know that cleaning up toxic spills and all of that is very, very complicated. But I'm new to it too, and I'm learning about that as well. The other thing that's really, really interesting to me is the fact that this company actually takes what looks like waste and then turns it into a viable product. It's a substitute for Portland cement, this green concrete. So to me, that's really, really exciting. And the fact that they've developed a piece of technology that they can actually ship to the utility and have the work done at the site of the utility, as opposed to transporting some of this toxic waste, that also seems like a theme that would be picked up. It's convenient for the utility. It's going to lower their costs, and it's going to reduce the risk of having some of this, for lack of a better word, toxic crap spill and then poison our environment some more. So to me, it's really exciting when you're handed a problem and you figure out a very creative solution. To me, that's something that I want to follow, because I think that you can build on that and effectively 10x that over the course of a number of years. And again, what we're talking about is a company here that is pretty much only doing remediation in the United States right now. There are a lot of other countries that have problems with coal-fired power plants and are going to need to have this remediated. So to me, it's just, I look at this and I think this is a huge avenue for growth. The amount of business that this company can actually get is huge. And these projects aren't, they aren't like 1 or 2 month projects. They're sometimes multi-year projects and contracts. So that's guaranteed revenue. And then the other thing, just to kind of get back to it, is, I'm really cognizant of the macro environment. We have this huge conflict in Europe. We've got rising inflation. We've got the Fed, not buying assets anymore, the tapering. And so, there's talk on some of these different financial programs of recession. And this company looks like it is effectively recession proof. So to me, that's really exciting. They also recently closed on one of the sites. There was the let me see if I can get it here. It was the Gibbons Creek electric station. They basically have that entire site remediated, and they're under contract to sell the land back. And on top of that, they also fixed their balance sheet. So they reconstructed their balance sheet and paid off an old loan that got new credit until 2026. So it actually makes the balance sheet look better too, which is one of the reasons I'm really excited for the next earnings report.
Awesome. Definitely putting it on my radar as well to check out. So thank you for coming on here, Ryan. Big shout out to you. Very smart guy. Love that take on Charah there. Would love to hear a little bit more about what you're doing with Benzinga. I see in your profile, you're the Director of Customer Success at Benzinga. What does that mean? And also, I'm going to throw in a second question in there, because that's what I do. Is there anything that you're doing personally, like any of your own personal newsletter or anything else like that you got going on?
So that's a great question. I appreciate you giving me the opportunity to speak on that. So I am the Director of Customer Success. One of our flagship products here at Benzinga is a financial news media platform. And by the way, that's how I follow some of these stories, right? Because I'm constantly going through news as soon as it's released. I've read a lot of these different press releases about Charah, as well as other companies. So my job is to help the consumer use the platform to benefit their trading and their investing. So how to use this is how do you use this platform? I create training resources for that. I help people on a one-on-one basis, as well as the rest of my team, use that product. And then it's also, fixing things like if something doesn't work correctly or it doesn't work as anticipated, it's my job to understand what it is that the client wants and then provide that for them in one way or another. So what I do on a daily basis, in addition to watching the markets and trading, I also really enjoy shorter term trading, although I would say my bread and butter is more swing and long-term investing, which is why I was so excited to join you folks today. In addition to actually watching the market, I actually support a product that provides news and other tools to traders. So I actually work with the FinTwit community for those that want a newswire or an audio squawk or a scanner suite, things of that nature.
Awesome, man. I appreciate that. So make sure you're checking out Benzinga. I see their Twitter account is down in the crowd. If you want to hit the follow button on them, and make sure you're checking out Ryan's personal account as well. Thank you so much for coming on here, Ryan. We appreciate you
Really
so much.
appreciate it.
Excited to have you on in the future one. But with that, I'm going to keep us moving. We still got about 5 minutes left before one. I'm going to slide us into wrap ups in just a minute, but I want to throw it over to my amazing co-host, Wolf Financial, see if there's anything you wanted to add in on the long-term investing topic, and definitely give us a little bit of a preview after of more spaces we got going on today.
Yeah, I really like this, especially when we talk about stocks where I'm either have them in my portfolio or potentially thinking about introducing them to my portfolio. AFRM, for example, that Simon talked about. That's certainly one that's been on my radar for a while, especially as it's come down from high level prices. It's just great to get that full, pitch and not have to, personally take, the hour or two out of the day to go ahead and gather all that research. So just to have these people that give us resources like Brad and Ryan and the seven investing guys who come on here often is really, really helpful for someone like myself. Just saves a lot of time. I trust them, and I know that they also have written up details on this. So overall, very helpful. In addition with that, certainly have my long-term portfolio, and in times like this, it's nice to get a bit of reassurance right on different areas as to, hey, although stock price might not reflect it, here's what's actually going on behind the scenes with these companies. Here's where the revenue growth is going. Here's partnerships that they're creating, et cetera, et cetera. Keeps us on the right path and allows us to have that long-term, 10, 20, 30 year, decade, or, multiple decade mindset in investing, because we know that the companies are still moving in the direction that we want them to. So that's my thoughts on the long-term investing stuff. Thought it was super interesting. Excited to continue keep doing these. And then on the spaces side of things, we do have a pretty packed day of spaces today. So the next space we're going to have is going to be in 2 hours. It's going to be pretty 180 from this. It's going to be focused on short-term technical analysis trading. We're going to have Brian Shannon on there, and we're just going to pelt him with a ton of different topics, or tickers and questions and crypto and all these different areas. So if you have specific tickers in your portfolio that you are looking at on also a short-term basis, that's a great space to come. We do put out a tweet. We take tickers from the audience and we chart them. And then at 5:30 p.m., we're going to do a real estate space. So that'll be real estate investing strategy. We're going to do that with the team over at Lex. We also have 3 different investors that are going to come on and kind of chat from their own experience in real estate. Of course, Ram Capital and Preet Patel and Stock Market News yourself always join us for that as well. So that's a pretty good one. And then at 7 p.m. and 8 p.m., we're going to do some more NFT stuff, featuring top projects, talking with artists, we have a couple CEOs that are coming on to those spaces. Specifically at 8 p.m., we're going to do a space with the Wenmint team. They also run the Whitelist project. Basically, they're developing resources and software around the Web3 world to assist those that are coming out and trying to build within it. So I think it's a pretty jam-packed day. If people want to see more about it, all the details are in my pinned tweets. So you can just go in there and kind of zoom in on the Thursday spot, and you can see all the speakers are. And then if you click into the pinned tweet, you can look underneath and see all of the speakers tagged. So that's everything from me, but great job. And also, we got Bullish Rippers, this account, through 19,000 last night. So if anyone doesn't know, I host 2 spaces a week from the Bullish Rippers account. We did one last night covering market analysis with Joe Fahmy, Jay Woods, and Brian Shannon. It was awesome. We had over 1,000 people came through there, and we talked about everything from CPI and QE to, I don't know, the rising tides of oil and everything else. With that, we're definitely going to do some stuff when we get this Bullish Rippers account to 20K. It's great tweets and content coming from it, plus these spaces. So I recommend checking it out if you haven't already. That's all I got for now.
Appreciate that, Gob. Honestly, that Spaces last night was a 10 out of 10, maybe the best one we've had from this Rippers account. So definitely go and check that. We're actually working on getting the YouTube video up now as well, so that should be there soon, but you can find the recording on this page. Just quickly, then I'll let all my speakers go into wrap-ups. I do want to give a big shout-out to Wolf Financial. We are kind of in my bread and butter here with long-term investing, talking about some of these larger stocks. But, I'm really grateful that I've been able to kind of partner and co-host all these spaces with Wolf Financial, just because, we're really trying to build a full scope coverage on the financial world. And this guy's going in there, grinding every single day, hitting all aspects of it. You really heard it on the spaces we have today. Long-term investing, trading, real estate, crypto, NFTs. There's so much going on there. So he's a must follow If you enjoy these spaces and you want to see it at the top of your timeline, big shout out to Wolf Financial. And I do want to drop a little bit of a teaser or something for going on. I don't know how much we want to talk about it right now, but Brad, we've been doing a bunch of these spaces together, the long-term investing one, and Brad and Bullish Rippers in general, the connections, the work, the partnership is only increasing from here. So we got some cool stuff coming in the near future with myself and Brad doing some cool things. So if there's anything specific that you guys really want to do, we're cooking up some ideas in the background, but if there's anything specific that you guys want, I'm all ears. So just send us a DM with something that you're really looking forward to. But super, super excited to have Brad more part of this team. He already kind of has been with doing the spaces and from my eyes, but excited to make it a little bit more official. I want to throw us into wrap-ups and start it over with Brad.
Yeah, excited to work with Bullish Studios so I can continue writing and continue keeping all the content 100% free. So I mean, they're going to help me monetize with some sponsorships, and very excited about that. So I love making everything I write as accessible as humanly possible, and that's kind of the way I see to do it, the way I see to do it best. So excited to explore that avenue. But in terms of wrap ups, just have a great day, everyone. Try and not look at your or for long-term investors, try not to look at your brokerage too many times in the day, especially in times like this of just extreme irrational volatility in both directions. Just for me, it's just slowly taking advantage of the deals as the volatility skews more heavily to the downside, and doing so in a very slow, meticulous manner. But other than that, that's all I got. Have a great day, everybody. And go blue. We're playing Indiana right now. We look great. Look great heading into the NCAA tournament. So Michigan basketball is on the rise, which is obviously the most important thing. But all kidding aside, have a great day, everyone. And thanks, Ev.
Go Bucks, Michigan sucks. And swiftly moving on from that, big shout out to Brad, give him a follow. I can't actually do that transition there, although that is how I feel. Go Bucks. But I'm gonna keep us moving and let Ryan come in with wrap ups. A little bit, anything more top of mind you wanted to add, and if you got anything else cool you're doing the rest of this week you want to hype up, I'd love to hear that as well.
All right. Thank you very much. Well, first of all, I'm going to side with Brad there. Go Blue. Obviously, Benzinga, we're headquartered in Detroit. We got a whole bunch of Michigan grads here. Go Blue. They are looking good. Hoping for a really exciting NCAA tournament. But the other thing that I wanted to say about long-term investing is this is something I agree. Don't try not to look at that, every single day, especially on days where things are really getting hammered. If you really believe in something, if you really believe in an idea, if you've put in a lot of time and research and you believe in this idea, then when you get days where the market is just getting destroyed, it's helping you out because it might be giving you an opportunity to lever into some of these longer term plays. This is not a sprint, right? We're in this for the long haul. So you might be able to actually add to your position, maybe even get a better price as long as that fundamental thesis doesn't change. I try to embrace that, right? Even in the play that I was just talking to you about in Charah, the last time that it sold down to the low fours, I was buying it. That's totally fine. I was totally fine with that. I have a longer term picture. It's not just the 5-minute view. So definitely don't check on it. And if you believe in something, stick to your guns and wait for that, wait and see if the story changes, because if you find a winner, if you're early, that's the way to go. As far as what's going on this week, I to just kind of promote myself, I do live trading Monday through Thursday on the Benzinga YouTube channel. We actually are doing it tomorrow as well because one of our events was canceled. So the live trading crew is going to do the live trading again tomorrow. That's more shorter term day trades. We really focus on the process, though. We don't necessarily focus on calling out different opportunities as much as we do the process, what we saw, how we traded it, what we can do better in the future. So if you're into live trading and you want to do it absolutely free with our group, just come on over to the Benzinga YouTube channel and check us out. We'd be happy to have you.
Awesome. Yeah. Shout out to the Benzinga YouTube channel. I definitely see you guys live there all the time. I know you have a bunch more content beyond even just the live trading, which
Yes, sir.
I'm sure does amazing. So yeah, shout out to the Benzinga YouTube channel and Benzinga in general, doing some awesome stuff over there. One more time, Really appreciate all my speakers for coming up here and providing some really amazing content. Thank you to all the listeners for coming in and receiving that content. It's really what makes it worth it. I appreciate everyone sticking by me this week. It's been super crazy with me moving apartments, and I got a lot of stuff going on. So love to see the support and everyone's still here. And just super excited to continue doing this, putting my head back down and continuing the grind for the foreseeable future. Before I fully end us out, I do want to throw it back to Wolf Financial. I know we got a pretty good coverage of what we got going forward, but if there's anything else you want to add in, would love to hear it.
Nothing else on my end. Big shout out to the speakers. Thank you for being a part of this. Thank you to the listeners for tuning in. We appreciate you as always. See you in about 2 hours on the next space.
Yes, sir. We're going to be live at 3 p.m. doing some technical analysis, a little bit of a switch up as well from the spaces with Brian Shannon, the creator of VWAP. His name is Alpha Trends on Twitter. Amazing account, always a 10 out of 10 spaces. So I'm excited for that. I'm going to quit blabbering and end the spaces here. As Wolf Financial knows, we have the patented 5 to 10 seconds of smile and waving. So the delay and catch up can be there. But I'm going to start my smile and wave, and thank you everyone for joining in.